So, as you know, Sri Lanka yesterday got IMF board approval, which clears the way for IMF's first tranche of money to flow into Sri Lanka. So, what does this mean for market interest rates? Theoretically, interest rates should now start coming down, and this is why. The IMF board approval not only allows IMF money to flow into Sri Lanka, but it also clears the way for other concessionary lenders like the ADB and the World Bank to now give us money. So this reduces the government's need to borrow money from the market, which in theory should bring down interest rates. That's point number one. Secondly, the IMF has come into Sri Lanka and has laid out a strong fiscal consolidation plan for the Sri Lankan government. So this reduces our fiscal deficit overall, which reduces the government's need to borrow to fund this fiscal deficit, which again puts downward pressure on market interest rates. Thirdly, if you remember over the last 6-7 months, investors were demanding very high premiums to invest in Sri Lankan government debt because of risk of default. What the IMF board approval does is it reduces this risk premium because now investors have more confidence in Sri Lanka. So with risk premiums reducing, interest rates also should come down along those lines. Going on to point number 4. With the IMF board approval and increased confidence in Sri Lankan markets, this clears the way for foreign investors now to relook at entering Sri Lanka. For the last 1 year, we have very little foreign investment into Sri Lanka. As foreign investment increases, this increases rupee liquidity as well. So with this increasing rupee liquidity, interest rates in the market will start trending down. Point number 5. Again, the IMF, like we mentioned before, requires stringent fiscal planning, and in addition to that, it also requires us to tighten our money printing. So you will not see the level of money printing in the last 2 years going forward. With this, we will see inflation coming down probably faster than even expected 6 months ago. With inflation coming down, again, it will give the government room to reduce its policy rates, which will then bring overall market interest rates down. The sixth and the final topic we can talk about is the fact that the IMF funds can also be used for budgetary support, which means that the government now again can reduce its reliance on borrowing from local debt markets to fund its operations. This again will reduce the demand for local debt and it will bring interest rates down.